Hello and welcome to today's ASX Top 50 video market update for April 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstance, and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals, have 22 years of experience in the financial services industry and a licensed securities and derivatives advisor. The format for today's presentation: we look at the global macro backdrop driving equity markets. We roll through the ASX Top 50. We look at FY18 and FY9 earnings and dividend forecasts. We conclude with the model portfolio market outlook. Moving straight on to a graph of the Dow Jones on screen here. If we look at the trends that have played out in US equities, after the Dow trading up to around 26,000 odd in the early part of 2018, we had roughly a 10% correction, which was predominantly driven by concerns around inflation pickup and the Federal Reserve starting to increase interest rates. And then after that correction, the market started to rebound, which from a technical standpoint, we were looking for a recovery at least to 50%, but in the end, it probably recovered about 60 to 70% of that initial 10% correction. And then this second wave of selling that's hit the market, a large part of that has been concerns around trade war fears. But really what sits behind those concerns is a very elevated price to earnings multiple for particular sectors of the US equity market. So certain market leaders, Facebook, Amazon, Google, Netflix, are all trading on quite stretched PE valuations, as well as the broader market. And we're starting to see, I think, a situation where a lot of the good news is already priced into the market. Some questions being raised about what global growth really looks like over the next 12-24 months. US GDP is not growing at the 3.5% that the market had expected it to. It's probably running more at around 2% at the moment. And with a backdrop of the Fed sending the message that they're going to be raising interest rates, 3 to 4 times this year and another 3 times next year, I think the market's starting to ask some questions around where fair valuation is for equities. Last night in the US, we had a pretty strong reversal from a very weak opening, which was a bullish sign. And I think it's possible that a rebound in the equity market could see the Dow trade back up, maybe up to another 1,000 points higher than where it is at the moment. But we'd expect to see it to again run into resistance at or near those levels. In the domestic market, we've corrected around 5% from the early highs in January, have a very similar pattern where the market rebounded, it failed on that rebound, and then we've had a series of sort of cascading lower high formations here. Again, it's possible that we get a rebound back up to around 5,900 points, and this downtrend would still remain in place, even with a move back up of another roughly 100 points in the XJO to run into resistance around that 5,900. If we just step back a little bit and have a closer look at sort of where we're coming from. So you can see here the market starting to roll over, make lower lows, lower highs. So we could see a bounce higher and then a continuation of that move down to a test supported around 5,630 points. Within the top 50 stocks, AGL, we continue to like this name purely because it has defensive characteristics, and at 14 times earnings and a 5% dividend yield, selling a covered call, we're generating 10 to 12% cash flow out of AGL, and we think the company delivers about 8% earnings. Aristocrat, we're a little cautious here. The stock trades on a very high PE, and when you look at the backdrop with the selling pressure occurring in high multiple names in the US, I think that Aristocrat at 24 times earnings just looks a little expensive to us. Amcor, we like this name, 17 times earnings, 4.5% dividend yield. Buy it here and sell covered calls, turned into a 10 to 12% cash flow. AMP, we're cautious on this name. We're unhappy with the recent earnings result in February. The resignation of the CEO, I think, is a further concern. Some analysts are starting to look closer at AMP and put out some positive commentary on the basis that the company may be looking at sort of splitting the business into sort of the old AMP and then the new growth funds management side of the business. If that starts to play out, then maybe we take another look at AMP, but for the moment we're on the sideline. ANZ, the Australian banks have all been in a downtrend. If you go back 2 years ago, they've now corrected sort of between 20 to 30%, and even across the last, say, 6 to 12 months, they're off on average between 10 to maybe 15% from their highs. The context of the banks is obviously with the backdrop of the Royal Commission, not too much in the way of revenue growth. It's a pretty tough environment, and it's unlikely that that changes too much in the short term. APA Group, this is probably back at a level where support starts to develop on a 5.7% yield, but it's not in our model portfolio and it's not one that we're looking at. ASX, on the other hand, we continue to like this. We acknowledge it trades on a high PE around 24 times earnings, but on a 3.7% yield and the company growing earnings around 5 to 6%, we think it finds support and trades sideways, and we're happy looking at that at $55. AZJ, so a negative structure here. We had the algorithm sell here at 550. It was removed from the model and the stock's fallen away. Still not really on our radar at the moment. BHP, we like BHP from the point of view that it displays positive momentum, making higher highs, higher lows, but we don't see really what the catalyst is to drive BHP higher. So owning it at these levels and selling a tight covered call is the way to keep exposure there to BHP. Brambles, so we're seeing a gradual recovery here in Brambles where the companies guiding towards a slight pickup in earnings growth at 19 times earnings and a 3% dividend yield or 3.25% yield. The stock's attractive, but we're mindful that it's still in a negative technical structure here. But owning at these levels and selling a 10.50 covered call into December, staying exposed to the September dividend, again delivering around 10 to 12% cash flow whilst allowing for some capital growth there, so we don't mind Brambles. CBA, so if we look back 2 years ago, trading $96, here we are today at 73. Continue pattern of lower lows, lower highs, and right at the moment the stock's on the support level here at around $70. We may see a minor bounce, but we don't think the conditions are in place for a major recovery in Australian banks. Computershare, we think this stock's expensive, so we're not doing it there at the moment. CSL, we like this name. Acknowledge it trades on a very high PE, around 28 times forward earnings and about a 1.5% dividend yield. We last had an algo buy signal at around 120. But from a momentum standpoint, CSL still looks good and growing earnings somewhere within that 20 to 30% range. Caltex is one of the few names that we've been commenting on the blog and just reminding investors that this stock's corrected from 37 back down to 32. It appears good value down here at 13 times earnings and a 4% dividend yield, and we think that there's a place for that in portfolios, and investors should be thinking about Caltex there at the moment. Interesting, when I go through all these stocks today, one of the key takeaways is for the concerns that began in February where interest rates were going to rise, inflation was going to pick up. We saw a correction in the yield-sensitive names, so property trust, infrastructure names, all pulled back in price, and on average the sector retraced about 20%. The recovery or renewed buying interest in that sector has been quite muted, but right at the moment, it looks like we've got the early signs of some money coming back. So that'll be one of the key messages to look at in today's recording. So whilst Texas is not our preferred property play, you're starting to see the stock bounce off support there and a little bit of buying interest come in. Iron ore prices have been under pressure, which hasn't helped Fortescue, and the stock's making lower lows and lower highs at the moment. If we look at Goodman Group, algorithm sells signal. So we've kept away from Goodman just simply because we don't have the derivative overlay. There's no options available there. So our preference within the property sector has been GPT, and down here at around $4.70, the stock's on about 14 times earnings, 4.5% dividend yield. So buying it here, selling a covered call. GPT pays its dividend in June. So if you look at going out to September with a covered call and turn that sort of 5 or 6% income into 10 to 12% on an annualized basis. So we like GPT. Insurance Australia Group, this has been one of our preferred momentum plays within the top 50, and with the stock retracing back here to around $7.30, $7.50, we think it looks attractive. At around $8, it's full value. So again, this is an opportunity to buy the stock and sell a covered call. Insurance Australia Group trades on a forward dividend yield of about 4.5%, and we're looking for about 6% underlying earnings growth there. Incitec Pivot, I think this is one that you should have on your watch list. The retracement back here to around 350 creates a buying opportunity at 16 times earnings and a 3.5% yield. We think Incitec looks interesting back there at 350. James Hardie, we're cautious on this. We think the stock runs into resistance at 23, not doing anything there. Likewise with Lendlease, we've taken profit on this name. The algorithm signal flagged the sell here and it was removed from the model portfolio. Mirvac, acknowledge here we're under algorithm buy conditions. The stock's making higher highs, higher lows. Again, it's not our preference within the property sector, but the stock has performed well, moving from $2 up to $2.19 now, creating a higher high and higher low. Medibank Private, we commented on this on the blog, at 18 times earnings and a 4.5% dividend yield. The stock price pulling back from sort of 340 back to around this 280 level. We see that it's moving into a value range, and investors will be well served adding that into their portfolio. Macquarie Group, cautious here. We think at around this 105, 106 level, it runs into resistance, and we don't think Macquarie goes any higher. NAB, so if we look back over 2 years, it was trading 39, now it's 28. There's a bearish structure in place, and even the most recent algo sell signal just reminded us to remove this from the model portfolio at $30.50, and at the moment the stock's now down around 28. So until such time as the stock moves higher and creates a higher low formation, we're still fairly negative there on NAB. Newcrest, I think there's an argument that having gold exposure at the moment, Newcrest has back down at support at below $20. The dam wall failure that they had at the Cadia mine in New South Wales has impacted Newcrest, and that was predominantly the reason why we saw it fall from 22 back to 20, and I think it might be starting to represent value there, and keep an eye on that one. Origen, so within the top 50, the energy basket continues to perform well. Energy and healthcare have been sort of our two main overweight sectors. Origen, we can see here we've had a higher high, higher low structure, and at around this 850 to 880, we again think it provides a buying opportunity, and maybe selling calls up at around the 950 level. Orica, under algorithm sell conditions, so it was removed from the model there at around $19.40, and the stock's now about $1.50 lower and continuing to look like it wants to move to the downside. Oil Search, so we've got a bullish structure here, and we've had recent algorithm buy signals off this $7 price point, 20 times earnings and 2.5% dividend yield, but with a strong backdrop for natural gas prices and oil prices, we think Oil Search is well supported here. So I think there's an argument that that belongs in portfolios as well. Qantas, bullish momentum, higher high, higher low under algorithm buy signals here, but around $6, it's pretty close to full value. We have Qantas trading on a very modest PE of about 10 times earnings and about a 2.5% dividend yield, and the company's in the middle of a share buyback there as well. QBE, we can see the structure here remains negative, lower lows, lower highs. The most recent algo sell signal was at around $11, and the stock's now trading sub $10. So it's not until we get that bullish reversal into a higher high, higher low structure that we become attracted to QBE. We have QBE trading on about a 5% dividend yield at the moment. Ramsey Healthcare, so this had been a darling of the market, trading up on a high PE there at one stage of around 28 times earnings. We've seen that come back to 22 times earnings. Underlying earnings growth somewhere around that 5 or maybe 6 to 8%. But when you compare it to other healthcare names, it still looks a little bit expensive, and we may see it yet trade back to sort of more like a 3% forward dividend yield before it finds support. So we keep an eye on this, but certainly back between $55 and where it's trading at the moment, it starts to look attractive from a valuation perspective. Rio, a bit concerned. Our preference is BHP over Rio simply because of the energy exposure and the potential for BHP to sell their onshore oil assets in America, unlock some value, maybe return capital to shareholders. And I think that sort of de-risks the iron ore story a little bit, whereas the concentration of the metals in Rio's portfolio carries a little more risk. Now, putting that aside, we recognise that the algo buy signal here did a great job at around 57, and we've now got another buy signal here at 72, but our preference BHP over Rio. South 32, we had the algo buy signal there at around $2.50, and the stock's continuing to move higher and now pull back to support at around 330. Scentre Group within the property trust sector, 15 times earnings, nearing a 6% dividend yield. I mentioned at the beginning of the recording that we're starting to see money come back into these yield-sensitive names, and here's an example here where we're starting to see it being a bit up over the course of the last week. Stocklands, we don't mind Stocklands at 11 or 12 times earnings and a 6.5% dividend yield. We think fair value for Stocklands is probably more up at around 430, at which time you may want to look at selling covered call options over it. Sonic Healthcare, we like this name. We've taken profit on it at higher levels, and we're looking at this closely as an opportunity to get back into it. Around this $22 to $23 level is a good buying opportunity for Sonic. Santos, we had the algo buy signal here at around 460. And we've now seen a takeover bid for Santos at an approximate value of $6.50 a share. So we'll have to wait and see how that plays out. But I think that all just adds to this story of the energy complex looking attractive, and investors probably needing to remain focused on the big energy names within the top 50 as an area to drive returns from portfolios. Suncorp, a little bit cautious here, lower low and lower high pattern at around $14. The stock's continued to run into selling pressure at lower levels. So if we just look back across the last 6 months, from 15 down to 14.30, 14.50 down to sort of 13.90, and we just need to give this time to see whether it actually starts to develop a more bullish structure or whether it runs into resistance at again below that $14 level. Sydney Airports, we like this from an income perspective for portfolios, roughly a 6% dividend yield, owning it here and selling $7 covered calls, collecting the June dividend. You're turning that into a 10% cash flow on an annualized basis. Transurban down on support at $11. We think this is reasonable buying, given that we still feel that global economic growth is going to be below trend and interest rates won't rise as quick as the market's fearing. So at 5% dividend yield, buying it here, collecting the June dividend and selling call options makes sense to us. Telstra under a algorithm sell signal here at around $3.80, and the stock continues to move lower. The probability, I think, is that we have to be getting to a point where Telstra starts to find some buying support. But the safe way to play this is to really just wait for a reversal and the algorithm buy signal in the high, 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 low formation. Treasury Wines, high PE, 35 times earnings, 2% dividend yield. A little bit like Aristocrat, we have some concerns around whether that's sustainable. And it's not our preference for a large exposure to Aristocrat or Treasury at the moment. But within the model portfolio, again, we recognise that the algo engine has done a great job of these higher-low formations, and the stock continues to perform well in the context of the model portfolio driven off those algo signals. Vicinity, not doing there at present. Westpac, 2 years ago, $39, today $29. Over the last 6 to 12 months, the stock's corrected 20%. Back on support here at around $28. Looks like the banks are just likely to have a move higher, which is really, I think, just off the back of an oversold condition at the moment. Maybe at the margin, money coming out of resources going back into the banks, given that they've been oversold, but we don't see that rally having a meaningful recovery to it. Wesfarmers, I think the split of Coles from the Wesfarmers business should be a net positive, but I think the market's finding it hard to get excited about the exposure to a competitive grocery market business and what are already terrific sort of margins for Wesfarmers, and maybe the issues that Wesfarmers having in the UK as well. Is it an area that growth's going to be delivered? And we're seeing in the Wesfarmers earnings result that the earnings have contracted over the last couple of years. But on a 5.5% dividend yield, the stock's attractive. You just want to be running a very tight covered call to boost that cash flow. Westfield, I think, is good buying down here at $8.50. I think the fall in the French company that's acquiring Westfield, the stock has pulled back about 18%, which based on an equity and cash takeover deal that's already been locked in, the fall in the parent company is making the takeover price less attractive. But I think that just creates a buying opportunity. And I think as we sort of see this play out over the next 3 to 6 months, I'd expect to see Westfield back up at 9 to 9.50 range. I think it really is oversold where it is there at the moment. Woolworths, terrific earnings result in February for Woolworths, but the stock is expensive, 20 times earnings on a 3.5% dividend yield. So we don't think that there's really the catalyst for it to move too much higher. Woodside Petroleum, we like this. So within the energy complex, we see this trading back up and filling the gap to around $31. And we have Woodside trading on about a 5% dividend yield where it is at the moment. And there we are back to the index. So just to conclude with today's recording, so what we're worried about is we feel that the high PE valuations in global equity markets cap any meaningful rally. We're aware that global GDP is not growing at the rate that the market had forecast at the end of last year, and we have a backdrop where the Fed Reserve seems pretty adamant about raising interest rates. Maybe they don't raise them 4 times this year, maybe they don't even do 3, but I think in the end the fact that the Federal Reserves are withdrawing liquidity from the global markets, raising interest rates, PEs are high, tensions between China and America on the trade side, I think that it probably is enough to create headwinds for equity markets, where any rally that we get will probably be short-lived and run into resistance again. Thank you for listening in, and if you'd like to know more about the commentary of the market on a day-to-day basis, please join or log on and read the Investor Signals daily blog. Thank you for listening in.